Hey guys, I'm Daniel. You'll see me in the community hosting most of the finance content. Today, I'm going to run you through some of the basic terms and definitions that you may hear throughout Inflection. If you're familiar with these, then great. And if it's new to you, don't stress. We're here to help and get you confident with your finances. Starting at the top, we've got the revenue or the gross income slash turnover or top line, as we like to refer it to as well. This is generally at the top of all financial statements that determines the total income that your business has generated before any expenses are applied. This is a really, really good indicator of your position in the market. It's a really good indicator of growth, of performance, of efficiency. It's a super powerful KPI that all businesses need to track and set goals around. Moving down the line to our cost of goods sold or direct costs. So these are the expenses directly related to producing your revenue, right? So these could be from raw materials to labor and anything more or less related to generating that revenue. So things like rent and stuff are excluded, obviously. So the reason that we calculate the cost of goods sold is to give us an accurate gross profit. So we know exactly what we're making from the product itself. Gross profit I'll define shortly, but that moves us down the line into the operating expenses. So is what we define as sort of non-production costs. So they're things like rents, utilities, marketing, accounting, and general costs of running a business, your ASIC fees, for example. So these are not directly related in generating the revenue, but are necessary in operating the business, hence classifying as an operating expense. So this is really, really critical because sometimes your gross profit can be quite good, but the cost to operate is quite high. And if we're not factoring that into our pricing or our revenue, our profits are going to be impacted. So cost of goods sold and operating expenses can be more or less made up of two types of costs, right? One being fixed costs and the other being variable costs. Fixed costs are things like rent. It's fixed in, it's got a lease, you know exactly what's coming out every month on the month. Things like software and other whatnots are included. Variable costs, they fluctuate with production, sales, volumes, efficiencies. That's, raw materials that go up and down in price based on market. That's production labor if you're paying by the hour. This is any cost that does vary time to time based on volume, based on market, whatever the difference is. And these ones are harder to track and maintain and keep record of. And once you understand how your variable costs work, it's so much easier to plan and budget your sales forecast and your profits. Once we go through our costs, we get down to our gross profit. So this is simply our revenue, which is our top line, minus the cost of goods sold and direct costs. So this gives us the core profitability of the product that you're generating. So we like to break it down to a percentage as well, whether 30, 40%, 20%. It gives us a really good indication of how much profit does the product and the direct cost more or less produce. And then how much have we got left with to pay for our operating expenses? And that's when our net profit is determined. So our net profit is more or less our gross profit, which already has deducted our direct costs, less our operating costs and other things that are sort of more or less attributed to it. So now that we've got our financials running through them, we know roughly what our profits are. We need to discuss cash flow. And what do we mean by cash flow, right? So for us, cash flow is more or less the cash that moves in and out of your account, which is a lot of the times different to your invoicing. So businesses that are profitable on an invoice and what we would define as accrual basis sometimes can have cash flow difficulties. If your payments are too late, if your bills are coming due before your invoices are getting paid, we do need to pay for these. Even though you're profitable, you might be feeling the pinch. So tracking cash flow and understanding cash flow is super important to understand whether you are profitable, whether you're not profitable, and to highlight some potential issues that you may have. Bring me into accrual versus cash reporting. So cash reporting, you might hear that from your accountant or from us even in the community. That is the money that comes in and out of your account. We're looking at the total that you have collected versus the total you have paid. In many scenarios, our cash basis accounting and our accrual basis accounting can show completely different results. So accrual basis accounting, which is what we report to the tax office on for most businesses. This is how we track actual performance and efficiencies. It records our revenue and expenses as they're earned or incurred, meaning that when the invoice is sent or you receive a bill. This is a far more accurate way to track your performance because it actually impacts on things that you can control, more or less being your exertion, efficiencies, when you're invoicing, and when you're incurring certain bills. So as accrual gives us a really accurate, you can say long-term picture, cash basis determines our day-to-day positions because if we don't have the funds that have been generally invoiced, we can't make repayments and it's going to add to a lot of stress for a lot of small businesses. And part of the main problem is as a lot of small businesses are profitable, they might not be cash flow positive. And that's something that, certain projections and highlighting issues can potentially solve, such as, tracking your debtor days. How long does it take you to receive payment from an invoice? Could be a major difference between feeling like you're doing really, really well and feeling like you're not doing well. And now we move on to the balance sheet. One of the more confusing things for some small business owners, but I'm here to break it down for you and make it as simple as possible. So our assets are more or less resources that are owned by the business. So these are simple things like your balance in the bank, the cash you have in the bank, your inventory, your accounts receivable, money that's generally come in. A lot of what I just noted are current assets. So these are generally assets or things that you own that are liquid in, call it 12 months. Moving on to our long-term assets. So these are things that are not easily converted to money or not liquid. Things are like vehicles, assets, property, anything that has a long-term benefit for the business. So really, really good to understand where your money's being spent as well, because what our reporting can say is that, hey, we're doing really, really well. We are very, very profitable, but for whatever reason, we have no money. And a lot of the time could be you're reinvesting in your assets within your business, whether it is additional vehicles, whether it's upgrades, it's whatnot. But that's a really, really good way to more or less track where your money is going. Now, going down to the liabilities, especially our financial liabilities. So these are more or less the easiest way to call it is our debts, right? What do we owe? Our current liabilities, so things that are due within 1 year, things like our accounts payable, short-term loans, if you've got any, credit cards, those types of debts. And taxes, right? Taxes are almost is the most important one. That's where your GST liability will be. That's your pay-as-you-go withholding liabilities, your super liabilities. They all show up there as a current liability. Things that you're incurring that you will need to pay in the next 12 months. Our non-current liabilities are long-term debts. So if you have any long-term, 12 plus month loans, facilities, finance on your equipment, on vehicles, that's where it'll show up in your non-current liability. So we know that long-term debts, what our balance is remaining, we can track the repayments going into there. That is what that component more or less shows. So tracking that's super, super important for managing your debt levels. And you'll be able to see between your assets and your liabilities. Do you have enough assets to cover your liabilities and start using other ratios to come help you track, which we can work through during the inflection course. And you'll hear a lot of us use the word capital, right? So in short, it's more or less any funds that are introduced into the business, either by the owners via the form of equity or external sources, being debt. We like to refer as capital as funds that we're going to use for reinvestment, right? And it's super crucial for funding future operations, expansions, sometimes even covering expenses whilst we're getting us into a cash flow positive or a profitable position. So capital is simply money that the owner will inject in any way, shape, or form that's going to help us continuously progress. And capital can even come in the form of profits. It might be the profits that you're earning rather than taking or earning them, you're reinvesting them into your business. And we do treat that as capital. So you'll hear that quite a lot in our course. One for our finance bros, EBITDA. So earnings before interest, taxes, depreciation, and amortization. I am personally not a major fan of using this as a metric for small business. This is a venture capital term, but more or less, this is like an adjustable profit and loss where you take out certain components to give us an accurate measure of performance and, taking out our depreciation, non-operating costs, interest, taxes, and whatnot. A lot of banks use this, a lot of investors use this for small business and for the finance function for most owners. Not something we generally like to focus on, but it does come up during our time, and you will experience that as a business owner at some point. So that more or less concludes all the definitions that we have, that we work through, that you might hear throughout the inflection course. If you get stuck, reach out. You can reach us in the DMs. But more importantly, we'll have in the body below all of this written. You can always come back to it, refer to it. And good luck, and I'll see you in the other calls.